Have you been watching what's happening with gold? Because something extraordinary is unfolding right before our eyes. Gold has just broken through a 40-year resistance level, and the implications are staggering. Let me show you what's really happening. Gold futures have surged to around $3,750 per ounce, while physical bullion is trading above $3,700. The precious metal is up more than 40% in 2025 alone, putting it on pace for its best performance since 1979. This isn't just another rally. This is a fundamental shift in the global monetary landscape. What makes this moment so significant is that gold has finally broken through a technical resistance level that has held firm for 4 decades. When markets break through long-term resistance after multiple failed attempts, the subsequent moves tend to be explosive. We're not just talking about a temporary price spike. We're witnessing the birth of a new secular bull market in gold. Think about what happened the last time gold entered a phase like this. In the late 1970s, gold surged from around $100 to over $800 per ounce, an 8-fold increase. And that was before we had $34 trillion in national debt, negative real interest rates, and central banks around the world diversifying away from the dollar at an unprecedented pace. The technical picture is just one piece of this puzzle. Let's look at what's happening fundamentally. Central banks globally purchased a record 1,136 tons of gold in 2023, and they've already surpassed that figure in the first 3 quarters of 2025. China alone has added over 300 tons to its reserves this year. Russia has converted nearly 60% of its foreign reserves to gold. India has increased its holdings by 27%. These aren't random purchases. This is strategic positioning. Why are they doing this? Because they understand something that most retail investors don't yet grasp. The global monetary system is undergoing a massive restructuring. The dollar's role as the world's reserve currency is being challenged like never before. The BRICS nations, Brazil, Russia, India, China, and South Africa, plus the 9 new members that joined in January, are actively working to create alternative payment systems that reduce their dependence on the dollar. This de-dollarization trend isn't happening in isolation. It's occurring against a backdrop of persistent inflation, massive government deficits, and a Federal Reserve that's trapped between fighting inflation and preventing a debt crisis. The Fed has been forced to pivot from its hawkish stance, and the market is now pricing in multiple rate cuts for the remainder of 2025 and into 2026. Let's look at the market structure itself. The COMEX, where paper gold futures are traded, has been showing signs of stress. The ratio of paper gold to physical gold has reached alarming levels. For every ounce of physical gold in the COMEX vaults, there are over 100 paper claims. This is a fractional reserve system that works fine under normal conditions. But what happens when confidence erodes and more holders of paper gold demand physical delivery? We saw a preview of this in March 2020, when the spread between COMEX futures and spot gold in London blew out to over $70 per ounce. The system nearly broke. Now imagine what happens when major players start demanding physical delivery in a world where physical supply is already constrained. Mining output has been relatively flat for years, hovering around 3,000 tons annually. Meanwhile, all-in sustaining costs for miners have increased substantially, with many now reporting costs above $1,500 per ounce. This puts a floor under the gold price. Miners simply can't produce profitably below certain levels. The supply constraints extend beyond mining. Refineries are running at capacity, and mints around the world are struggling to keep up with demand for physical coins and bars. The U.S. Mint has repeatedly sold out of American Eagle gold coins this year. The Perth Mint in Australia has reported record demand. The Royal Canadian Mint has implemented allocation systems. These are telltale signs of physical tightness in the market. And it's not just institutional players who are noticing. Retail demand is surging as well. Gold-backed ETFs have seen inflows of over $15 billion in the past 6 months, after experiencing outflows in 2023 and early 2024. This represents a significant shift in sentiment among retail investors. Quick aside, if you're sitting on $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs work. It's in the description. Covers how to get physical gold into your retirement account without tax penalties. Worth checking out if that's relevant to your situation. Anyway, back to where this price is headed next. When we look at historical parallels, there are some striking similarities to previous bull markets in gold. The 1970s bull market was driven by inflation concerns, geopolitical tensions, and a loss of confidence in the dollar after the U.S. abandoned the gold standard in 1971. Today, we have similar drivers, but the scale is vastly different. In the 1970s, U.S. debt to GDP was around 35%. Today, it's over 120%. In the 1970s, the Federal Reserve's balance sheet was measured in billions. Today, it's measured in trillions. The monetary base has expanded by over 400% since 2008. These are unprecedented developments in monetary history. What about the 2008-2011 bull market in gold? That move was driven by the financial crisis and subsequent quantitative easing. Gold doubled from around $800 to over $1,900. But what's different this time is that we're not starting from a crisis. We're starting from a position where gold has already consolidated for years and built a solid base. The 2008 crisis was primarily a Western banking crisis. Today's situation is a global monetary realignment. Let's talk about what happened in 2011, when gold peaked at around $1,900. Many analysts point to that top as evidence that gold can't sustain higher prices, but they're missing a crucial detail. The 2011 top occurred when real interest rates, nominal rates minus inflation, turned positive. Today, despite the Fed's rate hikes, real rates remain negative when measured against true inflation, not the manipulated CPI figures. Speaking of manipulation, we need to address the elephant in the room. For years, there have been allegations of price suppression in the gold market. Whether through naked short selling, spoofing, or other tactics, large banks have been accused of artificially depressing the gold price. Several major banks have paid substantial fines for manipulating precious metals markets. But what's interesting is that despite these efforts, gold has still managed to reach new all-time highs. Imagine what happens when these suppression schemes can no longer contain the pressure. The geopolitical landscape is another critical factor. We're witnessing increasing tensions between major powers, from the ongoing conflicts in Ukraine and the Middle East to the growing rivalry between the U.S. and China. Historically, such periods of geopolitical uncertainty have been bullish for gold. Nations under sanctions or facing potential asset freezes are particularly motivated to increase their gold holdings, as gold cannot be canceled like digital currency reserves. The BRICS expansion is particularly noteworthy. The bloc now includes major oil producers like Saudi Arabia, the UAE, and Iran. These countries have a strong incentive to reduce their dependence on the dollar, especially for oil trades. The petrodollar system, which has underpinned the dollar's reserve status since the 1970s, is under serious threat. Saudi Arabia has already begun accepting yuan for oil sales to China. This may seem like a small step, but it's a significant crack in the foundation of the dollar-based system. What about the argument that gold doesn't yield anything? This has been the traditional case against gold, that it doesn't pay interest or dividends. But in a world of negative real interest rates, this argument loses its power. When bank deposits and government bonds are losing purchasing power after inflation, gold's lack of yield becomes a non-issue. In fact, it becomes an advantage, as gold cannot be devalued through printing like fiat currencies. Let's look at gold from a portfolio perspective. Studies have consistently shown that a 5 to 10% allocation to gold improves the risk-adjusted returns of a traditional 60-40 portfolio. Gold's correlation with stocks and bonds tends to be low or negative during market stress, making it an excellent diversifier. In the March 2020 COVID crash, both stocks and bonds initially sold off together, breaking their usual negative correlation. Gold, after an initial dip, quickly recovered and went on to make new highs. The demographic trends also favor gold. As populations age in developed countries, there's a natural shift toward wealth preservation rather than wealth accumulation. Older investors tend to be more risk-averse and more concerned about inflation eroding their retirement savings. This demographic shift is creating a structural increase in demand for safe haven assets like gold. What about the argument that cryptocurrencies like Bitcoin have replaced gold as the preferred alternative asset? While cryptocurrencies have certainly attracted significant investment, they've also demonstrated extreme volatility. Bitcoin has experienced multiple drawdowns of over 70% throughout its history. Gold, by contrast, has never experienced a drawdown of more than 45% in modern times. For risk-averse investors seeking stability, gold remains the preferred option. Moreover, central banks aren't buying Bitcoin, they're buying gold. In fact, central bank gold purchases have accelerated even as cryptocurrencies have gained popularity. These institutions, with their long-term horizons and focus on security, continue to view gold as the ultimate reserve asset. The technical picture for gold is equally compelling. After breaking through the $2,000 level that had acted as resistance for years, gold has established a series of higher lows and higher highs, the definition of an uptrend. The recent break above $3,700 represents a breach of the inflation-adjusted all-time high from 1980, which stood at approximately $3,500 in today's dollars. Looking at momentum indicators, the monthly RSI, Relative Strength Index, is showing strong but not yet overbought readings. This suggests that despite the significant move we've already seen, there's still room for further upside. The MACD, Moving Average Convergence Divergence, indicator is showing a bullish crossover on the monthly time frame, which historically has signaled the beginning of major moves. What about price targets? HSBC projects a year-end price of $4,050 for 2025, with a range of $3,700 to $4,400 for 2026. Bank of America has issued a target of $4,500 by mid-2026. Goldman Sachs recently raised their 12-month forecast to $4,200. These are conservative estimates from mainstream banks. More bullish analysts are calling for $5,000 to $7,000 gold within the next few years. To put these targets in perspective, if gold were to back even a small percentage of the global money supply, as it did under previous gold standards, the price would need to be multiples higher than current levels. Some analysts have calculated that a 40% backing of just the U.S. monetary base would require a gold price above $10,000 per ounce. Of course, no bull market moves in a straight line. We should expect pullbacks and consolidations along the way. The key is to understand the fundamental drivers and not get shaken out by short-term volatility. The smart money uses these pullbacks as buying opportunities. What could derail this bull market? A significant increase in real interest rates to positive territory could create headwinds for gold. However, given the massive debt burden, the Fed's ability to raise rates substantially is limited. A deflationary collapse could also temporarily pressure gold, as we saw briefly in March 2020. But central banks have made it clear that they will respond to deflationary pressures with even more money printing, which is ultimately bullish for gold. The psychology of this market is fascinating. Despite gold reaching new all-time highs, sentiment among retail investors remains relatively subdued. We haven't seen the euphoria that typically characterizes the late stages of a bull market. Mainstream financial media still gives relatively little coverage to gold compared to stocks and bonds. This suggests we're still in the early to middle stages of this bull market, not the end. Consider what happens when mainstream investors finally wake up to what's happening. Currently, global allocation to gold in investment portfolios is estimated at less than 1%. Even a small increase in this allocation percentage would represent enormous new demand entering a market with constrained supply. The gold mining stocks present another interesting opportunity. Historically, mining stocks provide leverage to the gold price, especially when gold is rising. With all-in sustaining costs around $1,500 for many miners, a gold price of $3,700 plus means profit margins are expanding dramatically. Yet many mining stocks are still trading at historically low valuations relative to the gold price and their cash flows. As we look ahead, it's important to understand that this gold bull market isn't occurring in isolation. It's part of a broader restructuring of the global financial system. The excessive debt, the monetization of that debt by central banks, the geopolitical realignments. These are all symptoms of a system that's reaching its limits. Throughout history, gold has served as a bridge between monetary regimes. During periods of monetary disorder, gold reasserts its role as the ultimate form of money. We appear to be entering such a period now. So what should you do with this information? First, understand that we're not just witnessing a short-term rally in gold. We're seeing a fundamental shift in the global monetary landscape. Second, consider your exposure to this trend. Do you have adequate protection against currency debasement and financial instability? Third, think about how to position yourself not just for protection, but for potential significant gains as this trend accelerates. The breaking of a 40-year resistance level in gold isn't just a technical event. It's a signal that the market is recognizing the unsustainability of the current financial system. Those who understand this signal and position themselves accordingly stand to not only preserve their wealth, but potentially see it grow substantially in the years ahead. The window of opportunity won't remain open forever. As more investors recognize what's happening, the easy gains will have been made. The time to act is now, while mainstream awareness is still catching up to the reality of what's unfolding in the gold market.